Last year, one founder signed a free contract with a market maker. 4 months later, the project had lost $6 million. The market maker had earned $6 million, and he didn't break a single line of the agreement, and it was all in the contract. No one read it. My name is Max Moris. I'm CEO of Cicada. I've been doing market making for over 6 years. More than 1,000 tokens have gone through my hands. Today, about money. What contract models exist? How much do services actually cost? And why free is the most expensive word in this industry. 3 models exist in this industry. Retainer, you pay a fixed monthly fee. Loan, you give your tokens to the market maker on loan. And the third option, free. This isn't a separate model. This is how loan is sold to founders who don't understand what they're signing up for. Let's break down each one. Now we start with the simplest one, retainer. The project pays the market maker a fixed monthly fee. The market maker trades on your accounts through API keys. He has no right to deposit or withdraw funds. You fully control your money. All profit from volatility goes to you, not us, you. We get only the amount you pay under the contract. No hidden upside, no surprises. This is the only model in the industry where interests are 100% transparent. We get paid for work, we do the work. Pricing. At Cicada, services start at $3,000 per month. The final price depends on the number of exchanges and the trading strategies. Pay several months up front, and we give you a discount. What do you pay for? A dedicated trading team and 24/7 support. Modern, secure algorithms for any task. Cicada's cutting-edge infrastructure built in C++. Access to HFT and quant strategies. A real-time online dashboard. You see every trade, every order, every metric at any moment. Risk control, weekly reports, and an individual approach to every client. Separately, I personally handle every listing and I'm involved in every project. Every client has a direct line to me. This is rare in the industry. For me, it's a principle. When is retainer the right choice? For most projects, especially at listing, retainer is the only real option. If your market cap is under $100 million, it's retainer. No alternatives. Now I'll explain why. Now the model that looks profitable. Loan. The project gives the market maker its tokens on loan, sometimes plus a stablecoin. The market maker uses these tokens as liquidity in the order book. There's no monthly payment, no invoice, but this creates a conflict of interest, and that's where the Trojan horse is hidden. Here's why. Let's take a typical hypothetical project. FDV, $50 million. Price at TGE, $1. To the market maker, you give a loan of 5% of tokens, and that's 2.5 million tokens, worth $2.5 million. At listing, you have hype. The price goes up, say, to $3. The market maker calmly sells your own tokens, the ones you lent him, at an average price of $3. The market maker has $7.5 million in cash. Next, now what happens with any project? 3 to 6 months, unlock start, the marketing budget runs out, the hype fades, the price goes down to 50 cents, and all this time the market maker keeps trading. He's not just sitting on cash, and he's earning on market volatility in parallel. Every price swing up and down, potential profit for him, not for the project, for himself, and that money also goes into his pocket. Then the final move. The market maker calmly buys back the same 2.5 million tokens at 50 cents. He spends 1,250,000, returns the tokens to the project under the contract. Terms met. Signature valid. In the market maker's pocket, Meshi's $6.25 million of clean profit just on the price difference, plus everything he earned on volatility over those months. The project has a collapsed chart, lost reputation, and the same 2.5 million tokens that are now worth almost nothing. And the most important thing, he didn't break the contract. He did exactly what you signed up for. You armed him with your own tokens and told him to trade, and he traded in his own favor every day on every swing. That's where the conflict of interest lies. The one I mentioned earlier. This is one of the most common reasons founders come to me from other market makers. Each one is certain his case is unique. It's not unique, it's just the math of the model. When someone tells you, our services are free, translate it this way. We will earn on you a different way, and we won't tell you anything about that way. Free market makers don't exist. They don't. If someone doesn't send you an invoice, it doesn't mean you're not paying. It means you're not paying in money. You pay in tokens, in control, in your chart, in community trust, and in the long run, in the project itself. Free cheese only comes in a mousetrap. Or if you prefer, that's just the reality of business. Either way, this is important to understand. That said, loan as a tool is not evil. Loan is an instrument. A hammer in the hands of a good carpenter builds a house. In the hands of a bad one, it breaks your head. It's about who's holding the hammer. When loan really works, first, if your market cap is over $100 million, at that capitalization, the market maker physically cannot move the price with a single loan. The volume isn't enough. Manipulation is mathematically impossible. Second, if you have small exchanges you don't want to deal with, give them the loan, forget about them. Third, there are exchanges where a loan agreement is a hard requirement. Coinbase is the most famous example. Without a loan structure, you don't get in there. And fourth, for large projects, this is actually a beautiful story. You give a loan to several market makers at once. They start competing with each other. Liquidity grows multiple times over. The spread tightens. The users who trade your token win from this. Everyone wins. The question isn't, is loan bad or good? The question is, where are you and what tasks are you using it for? 3 questions. Before signing, first, what happens to my tokens if the market maker sells them and then the price drops? If the answer is, we'll buy back at market, you know how that ends. Second, how quickly can I exit the contract if something goes wrong? If the answer is, you can't for the next 2 years, red flag. Third, are our interests aligned? If the market maker can earn when your project is doing badly, something went wrong before you even signed. To wrap up, retainer for most projects, especially at listing. Pay clearly, sleep peacefully, profit from volatility yours, control yours. The market maker gets only what's written in the invoice. Loan, a working tool, but profit from volatility here goes to the market maker, not you. And that's fine. At a certain capitalization, for specific exchanges, for competition between several market makers. And here's what's important to understand. Your market maker also needs to earn. This isn't charity, this is business. If the market maker doesn't earn, he won't survive, he won't invest in technology, he won't keep a strong team, and in the end, you'll lose. That's why sometimes loan is a good model. You solve your tasks, the market maker also earns. Everyone wins. The question isn't, should the market maker earn? He should. The question is balance and fairness. If your market maker earns 6 million while you lose 6 million, that's not balance, that's a parasite. If the market maker earns from the project's growth together with you, that's a partnership. Free doesn't exist, ever. If there's no invoice in the contract, there's something else in it. Read it, find it, calculate it. I'm Max Moris, Cicada. If you need help reviewing a contract, reach out. I personally review every incoming request together with my team. In the next video, a full checklist for choosing a market maker. What questions to ask, what red flags to watch for. Subscribe.